So good afternoon, everyone, and thank you for taking the time and the interest to participate in this webinar. You are the reason why we do what we do, and we're hosting this presentation because of the level of concern that people have had these days over tariff trends and what are we doing about that. So I'm sure this resonates with everyone because tariffs is more than a buzzword these days. And personally, we're hearing from you, and thank you for your contribution of expressing what concerns you about tariffs in particular. So by popular demand, we wanted to get in front of all of you to help address each component of this title. What are tariffs? Not to be overly simplistic, but we want you to understand what the assignment is. What are we hearing and seeing throughout all aspects of our clients and businesses? What are the strategies that we are embracing to leverage during this time? I'm so grateful to be joined by a partner of over 30 years, and I think 30 years makes a big statement. Garrett D'Alessandro is the CEO and CIO of Sandro Wealth Management. We've both been two intellectual minds and hearts that have traveled the same path together for over 30 years, and we love what we do, and we love being able to help you through times like this. So Garrett, thank you for joining me and to tackle some of our clients' biggest questions right now. And for the majority of this session, we will be prompting critical client questions that I've culled over the last several weeks and to hear your perspective on the current environment. So without further ado, I want to introduce Garrett D'Alessandro, Certified Private Wealth Advisor, CEO and CIO, among many other designations. And we're grateful to have you with us today.
Thank you, Frank.
So before we begin, I'm going to focus on four points for this meeting. And I want to say something a little about each one. We're going to focus on fundamentals. And Garrett and I, through the years, have always had fundamentals as a starting point of how we make decisions and run our respective operations. I could just exhibit, if I go back to 2008, 75% of the fundamental indicators, which is 15 out of 20 indicators, were negative. Today, 2 are negative. That doesn't lessen the significance of what's happening with tariffs, but when we manage your wealth, we take into consideration both economic and market conditions, as well as you and your station in life. So with that, there's the wealth management and how is volatility affecting you? We're getting calls every day. We're meeting with clients on a regular basis because of how that volatility and uncertainty is impacting them. Garrett and I have lived through the 89 savings and loan crisis, the 98 collapse of the Russian ruble, the 99.com, which I'm going to comment on as well, the global financial crisis of '07, and many of us can recently remember COVID-19 in 2020. But let me just single out the .com, because when we talk about behavioral decisions, and Garrett and I both are very sensitive to both the technical aspects of what we do, but we're also very much engaged with the human element. And I can remember sitting in between two clients, a 35-year-old and a 65-year-old at a restaurant, and they kept saying to me, everyone knows that technology is going to be going up and continuing to go up. And we saw a major double-digit drop in NASDAQ back then, but it took managing the human element and the technical element to get people to stay the course and to stay with their original financial plan. What's been very advantageous of working with Garrett through the years is we both strategically look at situations that might appear red on the screen as a negative, and we look for opportunities on how to mitigate not only tax risks, but also market and economic conditions. So before we continue, I just want to say that our working together is putting your interest, your values, and your goals in the forefront and we use the tools that are available in the industry to make things happen in a positive way. Goes without saying that everyone is aware, or certainly all of our clients are aware that tariffs are an issue. And your concerns can be validated by polls that indicate people are aware of tariffs, just like we had with other major crises. Garrett will elaborate on how this is different, but different from a standpoint of how many years it's been since we've seen this type of a impact on tariffs. And then finally, we want to get a little bit more specific in where your concerns lie, whether they're, when you go to the grocery store or filling up your car, or you're trying to buy chips for your computer, or your job or industry. We've had certain clients close businesses or have to modify their relationships with businesses because of foreign relations. And we recognize that since April, some of those concerns have elevated, and Garrett will respond to that. So in terms of the topic tariffs, Garrett, there is a certain wealth effect that takes place, and we certainly hear a lot of noise and discussion that centers around government policy and what people think. It's the uncertainty and the impact on confidence that always gets my attention when we're working with our clients on an individual basis, and what the narrative is that's impacting them throughout their needs in their life. So from your standpoint, how has your outlook fundamentally and from your viewpoint changed for 2025?
So we look at 5 indicators to compare where we were January of 2025 to now May 2025. And the most significant forces influencing the US economy are shown in the diagram below, which is the negative wealth effects, whether it's the stock market volatility or the bond market volatility, or other forms of wealth like housing. We also know government. There are changes going on. They call it DOGE, which is the Department of Government Efficiency. That's influencing the economy. You talked about tariffs, which is the principal conversation today, and how that affects the economy, and then the sentiment and behavior, which you talked about, which influences consumer and business actions. And when you take those 4 forces into account, you recalculate the economic growth, which is GDP, and comparing to the beginning of the year, where we thought we would have an above trend 2 to 2.5% GDP growth, we're now looking at a 1 to 1.5% GDP growth. And if I would put that in a context, it's okay. It's not where we were at the beginning of the year, but it's okay. Inflation at the beginning of the year, we thought could get down to 2.5%. And now we think, due to the forces that we reflect in throughout this conversation, we think are going to remain in the 3 to 3.5% range. So a little higher inflation as well. Corporate profits, which are heavily impacted by what consumers do with their spending patterns, are going to be somewhat lower than what we thought at the beginning of the year. We thought estimates for corporate profits could be 10 to 12%, and now we think they're going to be in the 6 to 8% range. And now you take all of those forces and you summarize those in a recession risk. And at the beginning of the year, we thought maybe recession had a 20-25% chance, and it's up now in the 35% range. And finally, the Fed and what might occur with interest rates, and where we thought they might reduce interest rates more at the beginning of the year than we do now. And we're going to talk specifically about why they might only have 1 reduction. So if we go to the next slide, the first quarter of the year, we actually saw the GDP report, which is minus 0.4%, and that is a negative. And usually, when you have a negative, you see consumption decline. But that wasn't the cause of the negative GDP. What was the cause was anticipatory behaviors related to higher tariffs. And you can see in the red bubble there, net trade, which is the difference between how much the US, ship abroad and how much Asia and Europe ship internally, was a whopping almost record minus 4.8%. And everybody understands you're going to bring in as many goods as you can before the tariff prices rise. And that caused a really big negative in the first quarter. And in addition, businesses spent and made as many investments as they could, again, to get away from the forthcoming higher prices. So those two were anomalies. And what you want to focus on is consumption, which, as you could see in the first quarter, it was positive by 1.2%. And then the final point I'll comment is the businesses in the country still added jobs, and that's good. 154,000 jobs were added during the first quarter. So summing up, the first quarter was lower than what we had anticipated, but we're still kind of moving ahead modestly.
Thank you for that clarification, Garrett. And that's helpful to understand what the impacts are. But could you get a little bit more granular on what tariffs are, how they work, and what are the economic impacts that we should be thinking about?
Mm-hmm. So we put together a schematic, and the first thing that we want to focus on is what a tariff does to businesses and consumers. The first thing that you want to highlight is governments collect the tariffs. Businesses have to actually pay the tariffs, but the government keeps the revenue. So it starts with the box on the left, government collects the tariffs on goods, and you have two lines across. Businesses either absorb those higher costs. So if I'm importing electronics or a baby carriage or clothes or some car parts, and it used to cost $1,000, if the tariff is 25%, I take $1,000 times 25%, that's $250. I, the business, have to mail the government $250. Now my cost isn't $1,000, it's 1,000 plus 250. And I either absorb that entire amount of $250, which would lower my profits, which is the second window there. And then lower profits, I'm going to hire less people and I'm going to do less investing. On the bottom scheme, if I don't absorb those higher costs, I bill the customer, the consumer, for 1,250. They pay more. When you pay more for things, you buy less of it. And when you spend more money, you have less disposable remaining amount. So you subsequently spend less. So if I have to spend 1,250 as a consumer, maybe I do that, but then I don't go on vacation or I don't go spend on something else. And there are direct and indirect influences. I just talked about the direct influences. The indirect are as important, although less concrete, and that is uncertainty. Frank, you run a business. I run a business. Most of our clients are running businesses or senior executives. And when we're trying to make decisions looking out a year or a year and a half, we want to make certain that the quality, the consistency, the reliability, the predictability, the outcome of that decision has the right experience. When I have no idea what my costs will be, or I think my costs are going to be up, I don't know if they're going to be up 10% or 25%, I'm going to make less decisions. And making less decisions is also influenced by my business state of mind or sentiment. And the final thing I want to talk about is the global supply chain. And let me see if I can explain this simply. If I'm in the business of importing shoes and shirts and clothes from a manufacturer in Asia, and I'm going to order 6 months ahead, and I know all of those goods are now going to cost 25% more, I'm going to very quickly call up a t-shirt manufacturer or a shoe manufacturer in a different country to see if another country can manufacture those goods with the same color and the quality and the size and all of the factors that I want. And that's very unlikely to find that very quickly. So now I'm in a scramble, and that causes this supply of goods from all over the world to be in a great state of uncertainty and flux. So that's a negative.
So Garrett, as you know, whether we're looking at our clients' portfolios, looking at their business, their net worth, um, cash flow, and so forth, and looking at those indirect and direct costs, we also have to think three-dimensionally on how this impacts their family and the relationships and so forth that they're doing what they do. So, in your perspective, looking into the future, we look at the past to draw from experience and facts and maybe theories. In the present, we're dealing with what we have to keep things moving. But what are you looking for, or what are you watching for in anticipation or preparing for looking into the future?
Mhm. This chart shows three dates. April 2nd, which was the announcement of a set of tariffs that were going to be charged on all imported goods. And that's that first 10% number you see on the chart. And I want to have people look at the date on that chart, and you would have to go back to somewhere around 1950. So this is a very long period of time that tariffs were anywhere close to the level of 10%. And subsequent to that, and through a series of retaliatory governmental actions around the world, those tariff rates were increased on April 12th to 23%. And again, if you scan back along the timeline, you would have to go back more than 100 years to experience what these tariffs rates represent. And then subsequent to that, there was a lot of activity in the financial markets, and they reduced those April 12th tariff announcements on May 14th to 16%. So what that all means, quite simply, is there is no model, there is no stylized financial calculation, there is no firm, not the Fed, not the government, not Wall Street, that can do an accurate measurement of what all of this is going to cause in terms of GDP, consumption, inflation, and interest rates. So on the table on the right, we have an assessment, and it's a range. And these are, we have to be very humble here for the reasons I just mentioned, that the actual outcomes are so unpredictable that these are going to be tested every week and every month. But essentially, it relates to lower growth, lower spending, higher inflation, and a possible mild activity decline. And if you go to the next slide, what we want to keep in mind is you hear 10%, you hear 20%, you hear 50% tariff rates. What does that translate into the economy? And what we want to emphasize, and this is a good point, is 73% of everything in the US economy is services, and services are not goods. 14% are goods. So all of the conversation related to tariffs only apply to, so far, the goods industries, and that's 14%. So if you have a 10% tariff and it affects 14% of our economy, that's 1.4% when you do the math. And the other point we want to make is the table on the right, which shows that the US has roughly 25% of all of our economic give and take and back and forth, import and export related to trade, which is a nice way of saying 75% of all of the stuff that we trade in does still come from within the US economy, i.e. 25% comes from trade externally and 75% comes from our own economy. And on the next page, what we do here is we take different goods that one might purchase, a household appliance, a car, clothes, pharmaceutical products, technology equipment. And on the chart on the left, you can see that the price increase could be somewhere between 2% and 5%. And the way to think about that is percentages and then the dollars. If I'm going to buy a new car and that car costs $50,000 and I pay 4% more, that's $2,000. That's a lot of money. And some people are going to say, no, thank you. I don't want to spend $2,000 more for a car. A t-shirt, if I don't know, a t-shirt costs $25 or $50. If that goes up 3%, I'm not really going to worry about $1.50. If I buy technology equipment for $5,000 and it goes up 2%, am I going to worry about $100? So all of these goods and the percentages are completely uncertain what people will respond, how businesses will absorb the cost, how much they'll pass along, what consumers' behaviors will be. And that's the schematic on the right. We try to give an example here. Let's say that the US settles on a 10% tariff rate. What amount of that 10% is the business going to absorb? So if I'm a manufacturing importer and I have a 10% increase, and I say, okay, I'm going to absorb 5%, then only 5% of that gets passed along. I'm going to put the supplier, and I'm going to say, hey, I want you to absorb 3% of that. Then that leaves 2%, and then I might pass along 2%. Nobody has any idea with certainty what all of these give and takes will result in when the goods actually lands on our shelves. And if you go to the next slide, what we want to do is try to put this in the timeline. Think about July 4th or I don't know, September, before you'll really start to see what we're talking about. And I think everybody appreciates you have the first stage. I'm going to order goods, and that's going to take a month or two. Then they're going to have to ship to the United States, and that's going to take a month or two. And then they're going to get put on the shelves, and that's going to take a month or two. So you have a period of time here before you actually see the result of all of these give and takes. And what we are looking at are what businesses are planning on doing. And you can see that red bubble there. So far, we are measuring, and it's a decline of about 2.5%, 3%. Businesses are saying, I'm not going to order anything this month. And that decline is pretty important because normally when you have businesses declining their purchasing intentions, somewhere around 3 or 4%, you then get close to a recession. And on the right-hand side, what we're talking about there is income after we buy goods and services. And we're watching to see if consumers pull back and don't purchase goods because they're higher priced, or they are purchasing these goods with higher prices, and then they have less money in the savings bank, and then future consumption will be lower, not immediate consumption. And on the next slide, you're going to see something that's very important, which is wealth. When we think of wealth, we think of the amount of money in our 401k and our profit sharing plan and our stock portfolios, our houses. And that is the amount of assets that we own. And over the prior 20 years, when someone had a $100,000 increase in our wealth, we would spend about 9% of that doing something with that extra wealth effect. Over the last couple years, the $100,000 increase in wealth has led me, or on average has led the consumer in the US to spend $34 or $34,000 of that $100,000 increase in wealth. And if the stock market goes down a lot, which it's not, it came back, And if it stays down, the potential is for people to have the feeling of less wealth, actually have less wealth, and they will spend a certain amount less as a result of that decline in the wealth effect.
Thank you for that, Garrett. And before we go on to the next topic, I just want to give context for our audience on how you can take a humbling statement like 100 years, you can show the relative impact, but you also know the net effect when we're going into advising clients. You used to, when we went out on appointments together, talk about the fundamentals of investing, that if you had 10 stocks, five might go up, 15%, five might go, let's say four might go up 15%, four might go down 8%. It's whatever the net is that ends up achieving. And we collaborate on taking the return after tax, after inflation, and after cost. So I'm grateful that you can put into perspective a macro view of economic and market influences. But now let's shift on to it could be a sensitive subject for some because they tend to come in with a preconceived notion of what's happening with the current administration. Why are tariffs being implemented at this time? This is not like an air controller strike. This is now affecting the pocketbooks of every citizen. So why do you think tariffs are being implemented by the current administration?
So several of these tariffs have a very valid, great American U.S. focus intent, and the outcome is likely to come true. And we're a strong advocate for fair, not free trade. And what we mean by fair, I don't want to necessarily get into, but everybody understands, generally speaking, we want fair trade. We're not opposed to that. In terms of boosting manufacturing production and jobs, let me say that yes, there will be some jobs created here. How many, how hundreds of thousands or millions of jobs? We're skeptical that we're going to go back in time and have millions and millions more manufacturing workers. That's not exactly what the majority of analysis indicate, but we do think some jobs will come back. We absolutely want to use what they call the World Trade Organization, and for countries that are violating the rules of the WTO, we want to hold them accountable. And we have China here. They clearly have violated the rules. They need to be held accountable. In terms of raising revenue, will some revenue come into the U.S. government? Yes. Will it be hundreds of trillions of dollars and solve all of our problems? No. And then the final point, this would be a wonderful outcome, but not something that I would place in high confidence, which is as a result of bringing jobs back, we're going to have lower prices for consumers. If you go to the next slide, we want to put in context the countries that are the principal trading partners: China, Europe, Mexico, and Vietnam. And those four represent the overwhelming majority. And just think of China and Vietnam as the same. As a part of unfair trade, China ships stuff to Vietnam and then it ships to the United States. So China and Vietnam should kind of be looked at to some extent as one. Europe, different entity all by itself, as is Mexico. When you're trying to renegotiate trade arrangements, think in terms of 18 months, 24 months, 36 months, 45 months. If you think of a quick kind of conversation like, hey, will you be fair? Yeah, I'll be fair. Okay, let's make an announcement. You can do that in a day. You can do that in a weekend. But when it gets down to what t-shirt, what color, what car part, what type of steel, what pharmaceutical, for what drug, what type of electronic, for what type of part, that takes an enormous amount of negotiating, and it takes excruciating detail to delineate and distill the car part, the serial number, the type of material, who manufactured it, what percent has to be manufactured, so on and so forth. And this is going to create an extended period of uncertainty which we think is going to go on for years. And if you look at the next slide, so Frank, you and I are going to go into the manufacturing business, and we walk down to City Hall and we say we want to build a big factory over here, and they say, okay, great, fill out this application, and a year later they approve it, and then we start to hire the bulldozers to dig the grass and put up the concrete, and that takes another year to get the permits. Then we put the bids out to the construction companies, and they take a year or two to build the factory. Then we have to get the parts and the machines, and we have to make sure they all run, put all the parts together. That takes a year. Then we have to find people to fill the factory, and then we have to actually produce the goods. Everybody can imagine that that's not something that's going to happen in 1 or 2 years. It's going to take 3, 4, 5, 6, 7 years.
That's an interesting analogy because it reminds me of being on a council for our time from our town, and how many years it took to do several initiatives. It is a process getting bids and getting approvals and things of that nature. So we have to prepare for short and long term implications of policy and administration. So there are a lot of differing opinions around globalization, and we've been tracking globalization and technology for decades now. Given the speed of change and given all the interrelated countries and parts, what are your thoughts going forward?
So when you look at the slide here, we want to make a clear statement that it is absolutely correct to say that in 1950 and 1960 and 1970, we had more manufacturing jobs. No question, some manufacturing jobs, probably 1 million or 2 out of 10 million that people cite as the total decline, say 1 or 2 million were lost because of this offshoring or outsourcing or foreign trade. But 70% of those were not related to offshoring. They were related to automation and technology and robotics and supply chain efficiencies. And that's very difficult for people to kind of put the two together. And what we show here on this bar chart is on the left, manufacturing employment. How many people, fewer, how many jobs, how many less jobs do we have in manufacturing? Absolutely correct to say that over the last couple of decades, we have 26%, which is millions of jobs, fewer jobs in manufacturing. But the bar right next to it shows the output, and that went up 22%. So you're asking yourself, well, now I'm confused. How can we have 26% fewer workers, but produce 22% more goods? Everybody knows the answer. Automation, technology, all of those improvements have made what we produce easier to do with fewer workers. And the final point, which is represented on the right, and this doesn't make it right or wrong, good or bad, roughly 330 million Americans, several million lost their jobs, but the other 320 million people have more employment, more income, more real per capita GDP. So it's a trade-off. In economics, it's always on the one hand and on the other hand. And you can see, if we go to the next slide, where are we gonna, or where do we think we should be bringing these jobs back in manufacturing as one or two examples. We said before, we want fair trade. We also want to protect ourselves. We want the greatest economy in the world. The United States has no peer when it comes to all of the dynamics that the US represents. We're all extremely fortunate to be US citizens. We should not be reliant 98% on the rest of the world, and in particular, some of these countries on the chart here, Korea and Taiwan, for 98% of our leading semiconductor chips. No person I know, I've spoken to lots of economists and lots of technology executives, think that that makes sense. Rare earth production, 88% of the critical elements that we use in all types of electronic and manufacturing applications are produced outside the United States. That doesn't make sense to us. So there are many industries where we do want and should have some of the production back in the United States.
Well, thank you for that context. And just for further context, you and I have lived through several Fed chairs, all different sizes and genders, some hawkish, some dovish. But monetary policy has always focused on employment and inflation. So going forward, as we look at those two realms that the Fed has to make policy on, what does this mean currently? These tariffs and the impact of tariffs, the globalization, what does this mean for the Fed?
So as the chart shows, the Fed has two jobs: unemployment, and that's a fancy word for saying how many people are losing their jobs, and inflation. Everybody knows that means we're going to pay more for what we buy. The Fed, fancy word for the Bank of the United States. The Bank of the United States wants to keep unemployment from going up and wants to keep inflation from going up. And on this chart, both are going up. That's not what the Fed wants. They can't conduct a magic trick. They have to pick one or the other. And what they are likely to pick is inflation. And if tariffs are passed along to the consumer, and if the consumer is paying those higher prices, inflation will rise and the Fed will not cut interest rates. On the other hand, if jobs are being lost, the Fed is supposed to cut interest rates, but they're not going to because inflation is going up. So this is a very delicate, very sensitive period for the Fed. But if they have to choose, they will choose to keep inflation from rising, and that will make unemployment go up more than it should otherwise.
So with that background, what we do for our clients as part of their overall management is to manage their portfolios. So what does all of this impacting, how is it all impacting client portfolios, and what are you and Sandra Wealth Management recommending?
Mm-hmm. So we're going to show you something that looks very confusing. And the takeaway from this is look at the gray blue bars. And when you look back over that 40-year period, there are a lot of gray bars going up, and there aren't a lot of gray bars going down. And all that means is we've been through all of the episodes, Frank, that you mentioned, the COVID, the great financial crisis, the dot-com. Despite all of those very difficult periods, the stock market reflects the dynamism, the innovativeness, the quality of workers, the technological innovation, the productivity of the United States companies. So we have great optimism over the intermediate and long term that gray bars, i.e. the stock market, will show good appreciation. It doesn't mean every single year that the stock market's going to go up. Many years you have a couple months within the year. Those are the red dots, -6, -8, -12, -16, but then it ends up during the end of the year. So everybody realizes that in the month of April, we went down tentatively, temporarily, about 19%. And now we're almost back to zero, i.e. back to flat. We have no ability to predict what the tariffs will be, what businesses will do, what consumers will do. We can estimate it, we can model it out, we have stylized econometric ranges, but the best strategy is on the chart that we're going to talk about next. And what this chart reflects is what we are favoring, i.e. where we're leaning into and where we're pulling back from. And what we want to focus on is lowering, if we're overexposed to equities, because the market average went up 10 to 15% over the prior 5 years, it's possible that a lot of people have more equities than their long-term, what we call normal range should be. So if you've benefited significantly by having lots of gains and you haven't rebalanced, you haven't reevaluated your equity, you probably want to trim that a little bit towards your normal range and slightly under your normal range, given everything that we said. And one of the reasons why is because you can get a good rate of return in fixed income, getting 4%, 5%. We're going to talk about alternatives in private fixed income, get 7, 8%. So we're favoring quality companies. We're favoring alternatives in private markets. We're favoring shorter term investment grade. What we don't want a lot of is small and medium companies. They're bearing the brunt of all of these tariffs. We don't want a lot of foreign exposure. We don't want a lot of Chinese or Taiwanese or European equities. We don't want a lot of trade exposed companies, even in the US. If you've had speculative investments and they've gone up, count your good fortune and call Frank and let's evaluate whether you should still hold on to what we call speculative investments. And then we have in the next chart, we have a nice representation of something that many of you are familiar with, which is the traditional 60-40, and that's 60% in stocks and 40% in fixed income. Over the last year, the total portfolio approach, it's a modernized view of the traditional 60-40, has moved from 60% and 40 to something called 50-30-20. And that 20 has four important contributing factors. It offers the potential for higher income or greater capital appreciation. It brings more diversification and risk management against rising inflation. And it also opens up the universe of opportunities that are not available to a 60-40 or what we call a traditional public market investor only. So Frank, you have started to move that traditional portfolio to a modernized total portfolio approach, and you've presented that to clients and they have seen the benefits. If you go to the next slide, I know when there's a lot of unpredictability, there's a wide range of possible outcomes. I want less downside. And another benefit of the total portfolio approach is either private equity or private credit brings lower downside exposure into your portfolio. And then the final slide, one of the things that we want to emphasize, if I was to say, take one slide out of this and put it up on your refrigerator in your kitchen, it's this slide. And the black bar shows what has happened over the past 5 years in the stock market, which we call the S&P 500, on average went up 15.6%. We do not expect 15.6% for the next 5 years. If we get 6% or 8%, we would be happy. The challenge with that is if you look at private stock markets, so you have public stock markets and private stock markets, we think the private stock markets could do better than 6%, perhaps 10, 11. On the right-hand side, we have fixed income, and a similar comment can be made that private credit, that's bonds in a private company, are more likely than not to offer substantially higher returns than public bonds. So public bonds might pay 4 or 5, private bonds might pay 6, 7, or 8. And with that, I'll turn it back to Frank.
Thank you, Garrett. And publicly and personally, I just want to thank you for sharing your intellectual capital with our firm and the tutelage that you've given us on that alternative space among the 5 other major categories that you and I dovetail very well with. I want to thank everybody here today for joining us, and we hope that this webinar was informative on first basis and what tariffs are, what their impact is, and potentially on your portfolio. We'd also like you to know that we're here for you, and we'd like you to take advantage. We're seeing every day re-looking at portfolios in terms of their weighting. We recognize that fixed income is showing some more predictable future income than some traditionals, and we'd like to make sure that you're at least exploring those options with us. Until we meet in person again, we want to just wish you a happy and safe Memorial Day. And thank you, Garrett, for all of your effort and energy that has been dedicated to our firm.
Great.